Invest better with the sound advice of Phil Grande at philsgang.com. When you listen to the advice of Phil Grande at philsgang.com, you'll find investing in the stock market makes sense with the right guidance.
People keep saying to me, boy, things are hard, things are tough. Boy, the market's really screwed up. And I don't agree with them. For us here at Phil's Gang, we make it so it's simple. It doesn't matter if the market's bad or good. We consistently do well because we make it simple. And just like for my listeners on the radio or on the internet or my podcast, we make it simple. We try to break it down so you really understand why the market is going up.
The stocks discussed on Phil's Gang are not in any way a recommendation or solicitation to buy, sell, or hold. If considering acting on information presented, we first recommend you seek out a competent, licensed professional for advice. Get ready for the radio show that tells you what Wall Street doesn't want you to know.
Oh, I'm a money magnet. Money's coming to me. Money sets me free. I'm a money magnet. Money's coming to me.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Radio Network. With your host, Phil Grande.
And welcome to Phil's Gang radio show and podcast. My name is Phil Grande, CEO of Phil's Gang. We're an education group. We've been in business since 1998, helping folks just like you teach you how to trade properly. So today was the big day. Everybody's waiting for this day. Big things were going to happen. But if you're listening to Paul, he's double talking. He's starting to backtrack just how bad the labor market is. See, here's the thing. He's saying that he's concerned about the labor market and his rate cut will fix that, which is a bold-faced lie. That's not why he did this. Not at all. It's not going to help the labor market. First of all, when you cut a rate, whether it's a quarter point, half a point, whatever, it doesn't show up in the economy or in your paycheck for a year. It has no effect for a year. So that's a bunch of BS. That's not why he did this. So Powell, the real reason he did this, because he knows that the deficit and the debt is killing us. And he also knows the only thing he wants to get rates down to help with the cost of interest, but he also wants to keep the stock market rallying. There's only three things that are keeping this market rallying. And no matter how bad the economy gets, no matter how bad things get, the market will continue to rally as long as, and let me show you my chart here. We'll switch over to my chart, you can see it. As long as we continue to increase the M2 money supply. And you can see right on this chart, if you look at this, look how the tech stocks relative to M2 money supply, how they're rallying. This is incredible. So it's the M2 money supply. Now what's that mean? That means they print all this money, they increase the money, they give it to the banks with specific instructions to take that money at low rates and give it to the CEOs so the CEOs can do stock buybacks. That way they don't have to worry about their lousy earnings. They can go on and say how great their earnings are. Earnings are terrific, but they're masking them because they are not terrific. But you're not going to know the difference. All you're going to hear is, oh my God, did you see the earnings? They beat their estimate. They beat their estimate by 1 penny. Well, who the hell got the penny? I've been trying to find that out for almost 50 years. Who got the penny? I've been trying to find that out since 1998. So what he's concerned about right now, okay, is the interest that we're paying on the debt and the deficits. And one of the big reasons he's concerned, and he wants to get those rates down. Now remember, two things are going down. One, he wants to provide liquidity and money to the CEOs so they keep pushing their stocks up without having to increase sales. The second portion is to get those rates down on the national debt. So, for example, we've had, in our national debt right now, the interest alone is just gotten insane. We had let me give you a number here. We're paying an interest alone right now on the national debt, almost $845 billion. I mean, that's just absolutely insane. I think I have that right number. Let me just check here to make sure. I don't want to give you a wrong number.
That's close to $1 trillion.
Yeah, more $1 trillion. We're paying almost $1 trillion in interest rates. So if we look at, if we take, for example, let me get it right here. And here we are. Okay, so the big lie. So he's saying that inflation was contracting as jobs were increasing. And that was a lie. That was a total lie, that inflation was contracting as jobs were increasing. And real inflation, when he was saying it was at 2.9, remember, we're getting closer to 2%, was really 5.8%, real inflation. Now, between August 2024 and March 2025, there was 818,000 fake jobs, and they've just been revised away. Another 911,000 fake jobs between April 2024 and March 2025, they were revised away. Now let's talk about what's going on with the national debt. So now the national debt is, again, 38 trillion. The deficit's 2 trillion. Now interest is the concern. In 2015, interest was 415 billion. Today it's 1 trillion. Now that's 2 times what it was just 5 years ago. So the net interest cost has totaled 882 billion in 2024, 1 trillion in 2025, and it's continuing to go up. Now, first of all, how did we get in such a mess in the first place that our deficits are insane? Well, COVID. If you remember, during COVID, and we had the presidential election starting up, what they wanted to do is print close to $6 trillion. Take the $6 trillion and send it home to their constituents. So they didn't have to pay their car payment. Everybody got some cash. Didn't have to pay your car payment. You didn't have to pay your mortgage on your house. People were loaded with cash. But the problem back then is that you couldn't get anybody to work for you. Everybody had so much money because the government was funding $6 trillion. And remember, that was printed money. That was borrowed money. And that money, that goes right on our deficit, which goes right on our national debt. So the big problem was we weren't productive. To get the economy to grow, you want to be producing. But instead of taking that money and put it into productivity, they took that money, it was a big welfare program. That's how we got into this mess. And he's really concerned about it because remember, Trump has to pay this debt off in 4 years. Because here's what they're doing. They got a big problem. They've been trying to pay low interest on their national debt. So what they've been doing, instead of paying 4%, they've been buying T-bills at 3.64%. So that's 1 year. If they bought at 3.51, they'd have to buy a 2-year treasury. 10-year, forget, 4.03. So what they did is when they saw this debt and this deficit because of the $6 trillion, and we weren't producing anything, that's what we're feeling now. Because once you stop productivity and you become a welfare center, it takes a long time to right that ship again. So now China, who is our lenders, they used to remember every time we get a shipment of goods from China, Japan, they would take the dollars that we paid them. Thank you for shipping all those goods over here. And now we'll pay you in dollars. They would take those dollars, and what would they do with them? They'd go walk right over to the Treasury Department and say, we'll buy your debt. We'll lend you money. Give me an IOU. No problem. They love doing that. But now there's a problem. They're not doing that anymore. Why would they? Look at the money they're making on gold. Look at the money we made on gold miners. So the gold mining stocks are up 92%. So you don't think China, you don't think Japan, even UK, who loans us money, those are our three biggest lenders. We got China holds about 765 billion, UK about 770 billion, and Japan about 1.3 trillion. They're dumping those treasuries. They're getting rid of them. And any cash that they're getting now when they ship us stuff, they're buying gold. So now Trump's got a real problem. So they've been, instead of going and borrow money at long term, they've been buying T-bills to try to keep interest rates down. Now, how the hell are they going to pay off this debt in 4 years? That's about that's about 10 billion a year. In the next 4 years, who's going to buy it? Our banks are gone. Our banks are gone. They're not going to buy. Would you? Gold's going to keep going up. So that's what he's really worried about. Now, on the same token, because this is so bad, he wants to mask it by keeping the stock market going up, get people excited. All you have to do is cut rates to get people excited, but you have to do something else. This is called financial engineering. Take a look at this chart here again. To get the stock market to go up, to do stock buybacks, we need cash. So we print all this money at near zero, and look what we've done with it. We've increased our money supply, as I told you a moment ago, and look how the stocks have going up with this money supply. Now, as long as they keep doing that, I don't care how bad how bad the economy gets, you're not going to get a crash. Now, we're eventually going to get one of the biggest crashes in history, so you better start learning how to sell short. Never mind going by Clorox or Coca-Cola or any of that stuff. You can't hide. There's no place to hide. You can hide under my desk. I have kids at school, but that's going to help you. So look at the stock buybacks. This is nuts. This is insane. I mean, the stock buybacks are just absolutely going crazy. So if you, and look at the numbers, 100 billion, 70 billion, 60 billion. The biggest companies, Apple, Google, NVIDIA, look at this, even the banks, JP Morgan, 50 billion, Goldman Sachs. I mean, they are, this is insane. And remember, when they do a stock buyback, and when their stock goes from $20 to 60, it's not going up because their revenues went up or their profits went up, because it's not happening. When you do stock buybacks, your earnings go up artificially. It's fake. That pushes up your stock price. So the bubble gets bigger and bigger and bigger and bigger. So the crash, I'm the one that's always told you, we're going to get a crash at some point. And boy, did I get hate mail when I used to say that. If you told anybody you're going to have a market correction or crash, you get inundated with hate email. So, as a matter of fact, everybody did. So what Wall Street has done is changed it. They don't call it a crash anymore. It's called a price readjustment. So now we got, so what he's trying to do is keep alive the stock buybacks. But to keep the stock buybacks alive, you have to have what? Keep alive increasing the M2 money supply. Now here's the big one. Here's the third one.
2 minutes.
U.S. margin debt. Look at the margin debt. People are going nuts borrowing money to buy stocks. We've never seen this before. So again, Powell knows on one hand, if he can keep the stock market going up, which he can. I mean, do you realize how bad our economy is? And the market goes up every day almost, makes new highs every day. Are you kidding me? I mean, our market is in such bad shape, but it goes up almost every day. We got historic national debt. We got, I mean, look at construction spending, the biggest drop since 2000. We got a terrible labor market, And the debt, I mean, my God, people are really hurting. They got their record delinquencies, mortgages, autos, credit card, our bankruptcies, personal bankruptcies up 24% since January. Small business bankruptcies up my God, 40%. So his idea is if he can keep the stock market going up, he'll get everybody looking that way, and then he'll deal with this other problem over here, the national debt. I mean, this is a huge problem because when you don't have Japan and China to go and buy your debt, who the hell's going to buy it? Who's going to buy these treasuries? The guy on the street? What are you, nuts? So that's what's going on. So this was a play to, again, address really the interest on the national debt, which is actually killing us. It's killing us. But they never talk about it, do they? No. So our banks are not only China and Japan and UK buying all this gold, they're not going to buy our debt. Even our banks, when they forced our banks to buy our debt treasuries, they were forcing our banks. And the banks finally told them, J.P. Morgan, Goldman Sachs, go to hell. We're going to buy gold. So even the banks told them to go jump in the lake. They're buying gold. So how's this going to all end? I'll tell you when I get back.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
When the stock market is volatile, how do you invest intelligently?
Hi, I'm Phil Grande at philsgang.com. There's no need for you to be panicking in a market that goes up 800 points one day, 700 points, then it goes down again. All you need is good advice, need good direction. You don't get that from your CNBC and the Fox business and all these crazy shows. You don't. Here's what you get from them. Thank you, Jim Cramer. But this is something that this really bugs me. Listen to this.
Our responsibility begins and ends with our partners and our shareholders, and that's it.
What? Their responsibility is to their partners and shareholders and not to you? Check my site out, philsgang.com.
When the stock market is up one day and down the next, you need the experience of Phil Grande at philsgang.com.
What a difference it makes in your financial life. philsgang.com. It works.
Welcome back to the Phil's Gang Radio Show. Want to know more about Phil's Gang? Go to philsgang.com or give us a call at 877-600-4264. Now, here's Phil.
Hey, welcome back to Phil's Gang, my podcast and radio show. Check us out. We've been in business since 1998, educating folks just like you. And it's free for 10 days. And think about this. 90% of people who are in the stock market, I'm talking about retail investors, have been losing money, 90%, for 50 years. 50 years straight. Why? Because they have to buy stocks to perfection. Because they only know one thing, how to buy a stock. And they always buy the stock at the wrong time. Instead of buying what we call our sweet spot, where you get the most institutions, the biggest players buying. It's called the sweet spot. Every stock has a sweet spot, and that's where you want to be. But if you're out chasing a bunch of stocks, you're never going to catch that sweet spot. But if you stay with the 6 or 7 best stocks, you always catch that sweet spot. And that sweet spot, it's very hard to lose money because that's where you get the maximum amount of institutional buyers, the maximum amount right there. That's where they all buy. And that's where you have to be. We'll teach you how to do that. It's not hard. Now, let's get back to what's going on here. So Powell forgot in 2000, what happened in 2007. A few days after what's going on here, same thing happened. The market went up, and a few days later, the market crashed because he's not paying attention to the inflation. He said, well, I'll deal with the inflation later. Okay, I got to get these rates down because I need to get the stock market, keep the stock market going up. And he knows as long as he keeps increasing the money supply, increasing stock buybacks, those two right there, okay, he can keep this market going up for a long time. There's other thing he does. He always talks about spreads are narrowing. Spreads are narrowing. What does that mean? Well, Wall Street will make sure that they take parking space in your head, that people or investors are buying more corporate bonds at low interest compared to treasury bonds at a higher interest. So if you have 5-to-1, then 6-to-1, then 10-to-1, it's narrowing. So the more you have buyers of corporate bonds, less treasuries, it gets narrow. They love that because they always say when your spreads are narrowing, that means there's not going to be a crash. There's not going to be a crash. The economy's doing well. So that's another thing they're preaching. So again, besides the M2 money supplies I showed you a moment ago, besides the the money that they're putting in right here, the stock buybacks, and the big one, of course, is margin debt. That's the big one. I mean, we never had so many people buying stocks on margin debt. It's crazy. So now here comes, what do? We got the cut. Now we got to watch and find out, what, our bond yield's going to fall? Our bond yield's going to fall? Remember, bond yields have been going down. And when bond yields go down, what does that tell you? It sends you a message. That implies lower interest rates. He's going to keep cutting interest rates. And if you look at the 10-year and look at the 2-year, it keeps falling. That means that there's going to be lower rates. That's going to benefit growth stocks. Now, what are growth stocks? Growth stocks are your big tech stocks. Now, bank stocks are doing well right now, but bank stocks normally aren't considered growth stocks, okay? Bank stocks are considered value stocks, okay? But they're acting like growth stocks because they're happy the interest rates are coming down because that helps them with all their delinquencies. We've never hit delinquencies like that. So watch for your falling yields. If the bond yields keep going down on your 10-year treasury and your 2-year treasury, those falling bond yields will benefit growth stocks. That means the economy, also it means the economy's uncertain. The labor market's getting worse. Our economy's just not growing. It's not going to grow. Now, so when you get bad news like that, it's good news. The bad news with falling yields, you cut rates and you're doing it because the economy's uncertain. There's weak labor market and slow economy and all that. Well, they're happy because, they got to cut rates because things are so bad. Now, when bonds are rising, yields start going back up. Then you switch to value stocks. We'll show you how to do all this. So you go back to value stocks. What are your value stocks? Well, one place, again, you go to your website and just, again, go look up value stocks. Go look up SCHV, okay? And once you look up SHAV and you got the holdings for SHAV, okay, I'll put it up here for you, and you'll see what value stocks are. Like, for example, all our box stores, okay? Those are value stocks. I'll put it up here for you. Well, here, I don't have to waste your time on that. So you got Coke and Pepsi, all those kind of things that people need, staples. And then you have, of course, like I said, the big retail stores. So those stocks are called, value stocks. And when yields are going up on your 10-year treasury, everybody starts buying those. So you just got to watch. The bond market's so important. The 10 years is important, but so is the 2-year. I always teach our students that the 2-year is really important because it gives you the insight into the economy and to the stock market, how well it's doing, as to yields, as to interest rates, as to stocks. How well is it doing? Remember, yields are about inflation expectations. And as long as you understand the message from the yields, what it's telling you to do, you'll be buying the best stocks. Now, if we go in and take a look, for example, today, which was interesting, if you looked at Home Depot today, Home Depot started to go up a bit, and then she started to pull back. Lowe's started to go up a bit and started to pull back. And Costco. Now, these are supposed to be doing good, right? Because yields, again, these are your value stocks, right? And your value stocks right here, everybody say, well, gee, if we got, people all go to Home Depot, and they go to Lowe's, they go to Costco, things are cheap. You'd think they'd be doing a booming business. No, because remember, if you got bonds and those yields are falling, and those are, remember, you got the benefits of growth stocks. You got to go look at your tech stocks. So that's what we're going to do right now. So let's go down to our tech stocks. So if you look at tech stocks, for example, and see how they've been doing today after this announcement. And you're not going to really understand what the market's going to do until tomorrow, because there's going to be everybody's going to have to digest this, because none of it makes any sense what he's doing, okay? But let's start with, I always watch ARK, A-R-K-K. To me, ARK is the sentiment of tech stocks. What are the majority of investors thinking? If you want to know the majority of the investors thinking about tech stocks, look at ARK. And you can see ARK today never got back above its opening high. Never got back above its opening high. Now you look at the one that's been really tearing the market up is Google. Now Google today didn't get back above its opening high. Now you would think that these stocks would be rallying. Why? Because bond yields are going to go down because he's cutting rates. So that benefits these growth stocks. So if you look at the Qs, same thing. You watch the Qs, and you would think the Qs would have taken off today and break out to new highs, but they didn't. But let's see what happens tomorrow. Now you go from there, let's go to your value stocks, your discretionary stocks. And again, those are, you can go to your, like your box stores, for example, like Home Depot and those sort of things. And we'll go do that right now. And again, they're not doing well either. So if we go to, let's just go down here to our, here we go, right here. All right, so our GDX, first of all, our miners, that's pulling back. Now I told my gang members, now we've been into miners for a long time. I said today, if he's going to cut rates, what you want to do is take more profits in your miners. Keep taking some profit in your miners, because if he's going to cut rates, okay, then the people are going to all of a sudden think, oh, gee, I'm going to go buy value stocks. I'm going to go buy discretionary stocks like Ford, those sort of things, or Coca-Cola or Pepsi. So right now, GDX is backed off a little bit. Okay, it did not make a new high today. Now, if we go down to, take like, for example, Johnson & Johnson. Now, you think Johnson & Johnson would make a new high today because, again, falling yields. Okay, he's cutting rates, falling yields. Okay, it should be I'm sorry, I meant Google again. So Google, if you look where it is today, this morning, the high on Google, okay, we had a high on Google this morning, I think it was around 251. So we're closing in and closing below the high today. Now you would think, again, anytime he's cutting rates, that everybody be running and buying any of these growth stocks. Now let's go to let's go to the value stocks. Let's see what they're doing with the values. Let's take Johnson & Johnson. That's not doing well either. So there's really either one are doing well. But I'll tell you what has done well is our banks. We got into banks about 4 weeks ago. I told them the banks were going to break out. Now, again, banks are rallying today. They're doing pretty good today. That's where some money's going into banks. And we've been in Bank of America, J.P. Morgan, we've been in all the banks for quite a while. So the banks are doing well. So those are doing good, well. But again, they're considered, value stocks, all right? But they're acting like growth stocks. Now, if you go in and you start buying, for example, if you go in and you buy leisure stocks, okay, like you buy, for example, any of the, hotels or cruise lines, they always do well when they cut rates, but they're not doing well either. So what's going on? He created a mess. He created a mess doing this by lowering rates. When you have inflation, he's confused everybody. Because professionals, all they want to know is one thing. Should I be buying value stocks? Should I be buying, Pepsi and Coke, discretionary stocks? Should I be buying automobiles? Or should I be buying tech, growth stocks? And it's really easy to identify that by just looking at your yields. But it's not happening. You screwed everything up. So with yields falling, you got stocks that should be going up that are going down. So we got to let this thing ease out a little bit. Okay, we got to let it ease out a little bit. Now, the reason we got into the bank stocks about 3 weeks ago, because I told them this would happen. And I said, the one place I do know, if they do cut rates, the banks would do really, really well, real well. And that's what's happening. So our banks are doing terrific. We knew that. Our gold, we got into gold a long time ago, got into gold miners. And we knew that when you got Japan and China, UK, our bankers, they're not going to buy our treasuries. They're going to be buying a massive amount of gold. Gold's going to do all right. So we've been in our banks, we've been in our gold, doing terrific. What makes it difficult now is you don't know what stocks you should be in as far as value, okay? And I mean, most people say, well, I can't get into value stocks. Look what's going on with the market. He's cutting rates. I don't want to be in value. But a lot of the value stocks are going up when they shouldn't. So what you do is this. To solve that, you just follow the money. And that's what we do here at Phil's Gang. And we have a great selection of stock picks, okay, that are doing terrific for us. You should check it out. I mean, you come for 10 days. You don't have to pay anything. We've been established since 1998. We know what we're doing. So the bottom line is you follow the money. When you get confused, not us, we're not confused. When the Fed's confused, when the Fed screws it all up like they're doing, the market shouldn't be this complicated. It's really simple.
9, 8.
If you have rising yields, you know what stocks to buy. If you have falling yields, you know what stocks to buy. But it's not happening. So then you just follow the money.
2.
And that's what we do. And you can do it too. So check it out. So be careful for the next couple of days till they sort this thing out, because he really screwed up things, okay? Join my gang, philsgang.com, free for 10 days. See you on the charts.
You have been listening to Phil's Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com. Or call the office, 877-600-4264. That's 877-600-4264.
It's up to me.